All right. Hey guys, it is Wednesday, November 16th, and welcome to our Team Fit Force call. Tonight we have a special guest. It's actually my hubby, Val, and he is going to be sharing information with us about basically your financial future. And this is not my area of expertise, but I know that a lot of you guys ask me questions all the time about your taxes and how to handle those, and just about other things when it comes to insurance or financial planning and stuff like that. And this is what he does. I'll let him tell you more about his job and his business and all of that. But basically, I don't think I really need to introduce him like officially to you guys, because you guys already know who he is, and where he's from and all of that good stuff. But he is the vice president of marketing and sales to, I think, for American Benefits, just marketing, for American Benefits Exchange, and it's a financial company that he and his business partner from his other job started. So they are, I'm just going to let him talk about it, because he does, for those of you guys that don't know, he does all of our financial planning things. And basically I've told him, I just want to make the money. You tell me where it needs to go and you do whatever you want with it, because I just need to know, I want to make sure that we're set up. And he's made sure that we do our taxes properly, that we save enough money for taxes, that we have financial savings for our kids, for ourselves, retirements, and all of that good stuff. So we're really careful with our money, and Val is somebody who balances me out and has taught me how to be much better with money. And so I'm excited to hear what he has to say, and to have him help teach you guys tonight too. So I'm going to go ahead and turn it over to Val. Go ahead, baby.
Okay. Well, thanks, honey. I'm going to share my screen right away so we can get rolling. Let's see.
You guys can't see, he's wearing our Team Fit Force hat too.
Yeah, I've got the hat on. I figured I might as well do it. But okay. So like Lauren said, I kind of handled our finances, not just here in the house, but obviously for, the job that I do and the people that I deal with. I deal with people of all, I shouldn't say shapes and sizes. That's your guys' job. I deal with people of all different economic and different parts of the country, all over the place. So just hearing different situations and knowing what people go through on a daily basis and what their future goals are, I hear it all. So I understand that not everybody's the same. And what we'll talk about today are just some basic principles, some things that we do personally. And then also I can share with you, just some of, other scenarios and other things. But again, everybody's situation is different. So what I'm talking about today, hopefully at least one thing will resonate with you. It doesn't all have to make sense, but I'm going to try and make it as easy to understand as possible. And then also make sure you're protecting yourself and doing the right things for not only your business, but your family, and then your future, because that's ultimately what we're going to be talking about today. Let's see if I can get rid of my deal over here. Okay, so who am I? Well, Lauren already introduced me, and she wasn't sure of my title, but it's Vice President of Sales and Marketing. Our company is called American Benefits Exchange, located here in Austin, Texas, and I'm part owner of the company, very small portion of it, but I'm still an owner, which is awesome. And it's good to be a part like that. You guys own your own businesses through Beachbody, so you understand what it's like to own your own business as well. Some people know this about me. I'm sure most of you guys may, but a former baseball player. So I've learned a lot of my experience on the bad side of what to do with finances through my baseball career. And we've had ups and downs. Lauren can explain that to you and validate a lot of those things. So through my experience, and the same way that I learned how to play baseball better through my experience, through my financial experience, part of which was through playing baseball, I've learned what to do and definitely what not to do. So I'm coming with not just, hey, I'm on my high horse, this is what I do as a professional in my field now, but this is what I've experienced and what we've experienced as a family and how to set ourselves up properly now. Okay, I like this picture. Also father of two, and Lauren obviously mother of two, but this isn't your typical family photo. Obviously there's three of us that are doing kind of the right thing, and then there's one of us that's not doing the right thing, and that would be our daughter Audrey, who is half naked in the video earlier with Lauren. But so we're a regular family. This was taken outside of New York for my dad's wedding this past summer. Yes, I was at my dad's wedding. It's tough to say that. And then also a husband of elite Beachbody coach Lauren, who you guys all know, but I got to make that clear. I am her husband. And so I appreciate her allowing me to do this. And I've been asking for a long time, but I know you guys have a long list of other things you need to discuss, but I'm glad that we're able to finally have this discussion. So why am I doing this? Why did I really want to come on? Because I understand what you guys go through. Being in the insurance industry, it's very, very similar to what you do in Beachbody. So for instance, our organization is like the upline. So you have an upline person. Lauren, say, is the upline. She's Team Fit Force. I am the upline. I am American Benefits Exchange. Then we have agents underneath who are in our downline, and we don't build legs, but we just build structure on the downline like a big family tree. And most of our agents, basically every single one, they're 1099, just like you guys. I have been on that side as well, been completely 1099. Now it's a combination, but I understand from a financial standpoint, also from the way you guys do business. It's very, very similar, just we're selling different products and selling different things. But ultimately it comes down to a very similar structure of business. This stuff can be confusing, right? Who here is a CPA? I doubt anybody on the call is an actual CPA or a financial planner or a series licensed person that's going to do investments and stocks and bonds and things like that. So you need to talk to somebody that you can understand, that can make sense of it all, and get rid of this confusing stuff. I want to share, again, some personal stories as well as personal solutions, what we've done. You don't have to copy what we've done, but it's a suggestion. It's a guideline. And then, like I said earlier, everybody's situation is different. So if we can kind of make sense of all this and stop scratching our heads and just say, look, this is what's out there. This is what's available. This is what other people are doing. And what is best for you? Well, hopefully by the end of this, you may have a direction that you want to go in, or you may want questions that you have answered because of some of the information I'm going to share. Today's agenda. So let's see, what are we going to cover? Well, the need. I understand the need for this, like I just said. We'll talk about 1099 and taxes because that's really exciting, 1099 and taxes, but it needs to be discussed. Some insurance options, right? There's things we need to take care of from an insurance perspective. I'll show you that, as well as your financial future. So it's weird sometimes for people that are our age, younger or older, to really think about the future in retirement because it seems like it's so far away, but that planning needs to start now. And whether you've done 10 years of planning or you haven't done a single thing, it's never too late. It's never too early to start. And again, I'll share with you things that we've done. Okay, so I said the need. Well, what is the need, right? It could be confusing. What's right for you? And this is my picture here, person shrugging. You don't know what you don't know is a big thing that we say in our industry. I deal a lot with employee benefits, and people just assume they've got their benefits are covered. And a lot of times it's not. And when you open their eyes to what is out there, what they should be doing, they did not realize what they did not know. So today, hopefully we'll share some of those things that you did not know about and open your eyes to some things that are available. So what kind of things are we talking about with this need? Well, you're making money in your business, whether you're making a little bit of money or a lot of bit of money. Perhaps it could be more than you've ever made in your life, and it's awesome to have this, but with that comes a little responsibility and making sure that you prepare for what comes ahead. You may never have been a 1099 person before. Okay, commission only basically, and none of your taxes, your Medicare, all the Social Security, none of that is coming out of your check. So how do we handle that properly? Tax education. So I'm not a CPA, but do you have a CPA? Are you preparing for your tax liability at the end of the year, or is it kind of like a shock when April 15th rolls around and Uncle Sam's wondering where his money is? So I'll give you some rules of thumb and some things that our CPA has told us over the years. Family. So again, it goes along with making money to properly have a comfortable lifestyle. Are you protecting that lifestyle? Are you protecting the ones you love? Are you protecting your job, your ability to make money, things like that? And then finally, your future, right? So how do you meet your end goals, and what do we need to do to get there? And do you know all the things that are available, things that you could be doing or taking advantage of? Okay, so that's the need. Again, I think that's pretty clear. That's why I'm talking tonight, is because of that need. We're going to share some information, but I want to start with the most boring stuff, and that has to do with taxes. Okay, so you're 1099. Obviously, that means you're commission only. You're getting paid your income that you make and any bonuses. It's coming to you as gross income. You don't know taxes are being taken out, whether you live in a state with high taxes or a state like Texas that has no state tax. You're still due federal tax. As a self-employed person, you got to pay both self-employment tax. You got to pay Social Security basically for your company and for yourself as an individual. So there's more tax liability there, and things like that. So let's just go over a couple things of what my CPA said. And this is generally what he told me to do. He said, when Lauren gets her check every week, because you guys obviously get paid weekly, which is awesome, he said, take off 40% right from the top and put that aside for future tax liabilities. I was like, okay, that's great. I mean, he's like, if you're not in the 40% tax bracket, because you're not going to be, because the highest marginal tax bracket right now is 39.6. So you're not there. We're not going to be there, but take 40%, put it aside. I said, okay. So that was a good rule to start with. And then I kind of made it our own. So what do we do in actual practice? Lauren gets her check and she says, I handle it. So I'll go into our bank account and I understand that I need to take money away from Lauren so she doesn't spend it. Now, that's not a knock on her. She said she's not great with all this stuff. So I'm the tight wad and she is the spender. So we kind of meet in the middle and I handle that part of it. I handle the finances and I go into her account and immediately we give our top 10% to charity. We give it back to our church. So I take 10% off the top right away. What I do with the rest of that, now I've got 90% left. I take half of that 90%, which is essentially now 45% of the whole, and put that aside for taxes. So I'm actually taking more above and beyond. And then the remaining half or the remaining 45%, we can move around and she can use for business expenses, things like that. But I want to absolutely, positively make sure that we are covering our tax liability, because that you don't want that to be a huge shock. Like I said, when you go and Uncle Sam has this big bill and you realize that Uncle Sam isn't necessarily your good uncle and he didn't teach you how to do your business or anything like that, but he still wants his piece of the pie, you got to provide that for him. So put that money aside so you absolutely make sure that put it aside right away, so it's almost as if you never had it. That way it's in your savings account. If you have a business savings or a personal savings, move that stuff aside so we can do that. And that's what we do. All right. And it works for us because of the system we've kind of developed. And I'll go in tomorrow, being Thursday, I'll go in tomorrow and do the exact same thing. And we just do that. So again, when the bill comes the end of the year, it's easy. We've got it in there, write a check, and there's going to be money left over because I've over prepared. And we can put that into other things that I'll talk about that we have. Pay your quarterly estimates. So if you're not set up, or if you haven't talked to a CPA about what you make, pay your quarterly estimates. If you're not paying quarterly, I definitely recommend looking into it. That means you're paying on April 15th, you're paying on June 15th, September 15th, and then January 15th. Those payments are due. It's not exactly 3 months apart each time. I don't know why they did it that way, but those are the times your quarterly estimates are due. And then also track all of your expenses, right? So at the end of the year, as you go, and this is something that I do at the end of the year, just me personally, but Lauren tracks all of her things as she goes. And if you've got a QuickBooks software, if you've got a spreadsheet or something that can track the different categories that you have and track all of your expenses, that way at the end of the year, when you go and file for your taxes, you know how much you made because you'll get just a 1099 from Beachbody, and you know all of your business expenses that came from that. And you've got it easy to understand, easy to hand to the tax preparation guy or your CPA, and then they can go through their process and make sure that your return is filed properly. But the more expenses you have, obviously it's going to lower your overall taxable income. So track all that. Track every penny. You think it's a write-out, write it down. Let your CPA tell you that it's not. But try to track everything that you can. That way, again, you're lessening your tax liability at the end. Okay, so got through the boring part. Now let's get into the fun stuff, right? Some of the insurance options and things that you can do to protect your financial future, protect your family, protect all the people that you love and care about, as well as your business. Okay. So you're talking about yourself, your spouse, and then those miniature versions of yourself. We call those your kids. You saw ours running around. You see them in the pictures. And sometimes I wouldn't be surprised if they pop through this door and come in right now. But we're going to talk about these options for everybody. So not just yourself, but also things for your spouse and your children. So let's see. First question I'm going to ask is, what is your biggest asset? Okay, what is your biggest asset? Now, a lot of people, when they think about assets, they think about tangible things, right? Like my house, my car. I may have some expensive jewelry or things like that. Those are physical assets, yes, but what is your biggest asset? And a lot of people don't think of it this way. Your biggest asset over the course of your life is your ability to earn an income. Okay, that is your biggest asset, your ability to earn an income. And if you can't do that because of disability or because of the fact that something happened to you that was terrible, and you can't, well, how is your family supposed to carry on? And I hate to be morbid about it, but we're talking about life insurance type stuff. So your biggest asset is your ability to earn an income. And those are things that we need to prepare for in order to do it, in order to make sure we're properly covered. Sorry. So how do you understand if you're properly covered? How do you know if you have enough insurance, if it's life insurance or anything else? Well, think about this. You insure your car without even thinking. One, because you legally have to. Two, you insure your house without even thinking because, well, that's what everybody else does. You know, they get homeowners insurance. If you rent a place, you're supposed to get renter's insurance. We got caught with that one time, and it turned out pretty bad. So you get renter's insurance in case something happens. But when it comes to life insurance, people think that, and I'm not going to knock myself, but people think that life insurance salesmen are like sleazy or greasy, or they're kind of slick and they kind of do things, you know, in a unethical way. Well, again, there are some bad cases, but in the right way, life insurance can be a very good friend of yours and provides that protection that you desperately need. Now, I say need, you don't want to use it because obviously you have to die to use it for the most part, but you get car insurance again and hope you never get into an accident or have to use it. You get homeowners insurance and you hope you never have to use it. And if you do, you're glad that it's there. But again, you get these things, pay money for them, pay high prices at some places, and you hope you never have to use them. Life insurance, same way. It's not something that you want to use, but it is something that you're glad you have, or your family is glad that is there in case something happens. So I want to talk about now, how do you know the proper amount of life insurance? And we're going to do a simple principle here. I call it the dime principle, but it's a simple way in which you can calculate in your head right now, even as we're sitting here, about how much life insurance coverage you need. And most people that I talk to are underinsured because they never thought of it in this way and things that you need to think about covering. So let's start with the letter D. D stands for debt and death. Now, what does that mean? Well, it's the amount you need to pay off any outstanding debt. Auto loans, credit card loans, student loans, things like that. Your non-home, your non-mortgage debt. And I'll get to that in a second. Also death, meaning final expense costs. So what are your wishes? Now, it's tough for us to think about that now. Do you want to be buried? Do you want to be cremated? What are your final plans? We don't need to really necessarily have that all figured out now. But also when it comes to death, do you want to leave a gift, a legacy gift to your kids or grandkids, what have you? That would be considered in the death portion of this. So debt, auto, credit, student loans, and final expense costs or legacy gifts. That's the first one. Now we add to that income, right? So income replacement, amount needed to replace you and your spouse's income. So if it's just on you, it's going to be your income. And for how long? Do you want to replace that for 2 years, 5 years? Is it something that, how long would it take your family to adjust and get back on their feet? Generally speaking, I use 5 years as a rule of thumb. It could be a few more, a few less, but the amount of money that is needed to replace your income and for how many years. On top of that, I talked about not including mortgage in the debt earlier. Mortgage is generally the biggest debt that you're going to have. The biggest loan that you have is your mortgage. So on top of that, the amount needed to pay off the outstanding balance on your mortgage. Now, obviously, over time, that balance decreases, but a lot of times people and I've seen that a lot of times people don't stay in their house 30 years or long enough to gradually pay that off. So they'll always be carrying a mortgage similar to a car note. A lot of people, by the time their car's paid off, they want to get a new car, so they always have a car payment. With mortgage, it's very similar. So the amount needed to pay off the outstanding balance in your mortgage, we add that to the top. And these are things that can be adjusted over time. You can always get more insurance if your situation changes and you find yourself to be underinsured. The last one, E, is something that a lot of people don't think about, and this is future education costs for your kids. I'll use our example. We've got 2 young ones at home. Right now they're 7 and 3. If something were to happen to either Lauren or myself, they have future education costs that we want to make sure that they are covered. And in the event that something happened to either one of us, we want to make sure that our policies take care of that. So the DIME principle, if you ever think about how much insurance you need, just think about DIME, death and debt, I for income, M for mortgage, E for education. There's a simple worksheet that I have also that we can use to fill this out, but should be easy to understand, easy to remember. Okay, so that's calculating your total insurance need. Now, creating a proper insurance plan is the next step. Once we figure out what that total number is, well, how do we create this plan? What are our options here? Well, there's generally 4 different options we can choose from here to help secure or even insure or self-insure that amount of money. First is term insurance. Now, if you're not familiar with term insurance, term is like renting. It's like renting a house or renting a car. You pay money, you get something, but you don't have any equity or stake in that. You're just borrowing it for a certain amount of time. This is very good to have because you can get the cost is less. So you can get a significant amount of term insurance and not have it cost a whole lot of money compared to other types of plans. But again, once that term is up, like renting, like when your lease is up, you don't own that house, you don't own that apartment, it's over with. The term is up. You can get a new term, but maybe at a different price or a higher price because now you're older and a different health. So term insurance is great. I'll share with our situation. We have Lauren and I have significant term insurance policies on each one of us, covering the bulk of that number. Because again, this is the most cost effective. I understand that it's going to run out at some point, but then I'm going to fill that void with something I'm going to talk about here in a little bit. So we both have significant insurances, and using that DIME principle, you're trying to secure all of that total number. The second is permanent type of insurance. So permanent plan is exactly what it says. It lasts forever. As long as you keep paying that premium, that permanent insurance will be there for as long as you live. And that's good because you know that at least you'll have something. So usually a combination of term and permanent insurance is the way to go because you can get a significant amount up top with the term, and then you want to make sure when that runs out, you at least have a baseline there that'll cover, like you said, your legacy gift, those final expense, burial, cremation costs, whatever it is, as well as any other your remaining debts you anticipate having or things you want to cover. So a combination there is great. Now, on top of that, what else can we be doing? This is just the life insurance portion. Now, I will pause and say this too. Life insurance in a traditional sense pays only when you die, which again, people are like, why am I going to get life insurance? I don't ever use it. It doesn't benefit me. Well, that's kind of selfish because it does benefit somebody. It benefits your family, your kids. But the new insurance, both permanent and term, comes with living benefits, meaning you don't have to die in order for the policy to pay you something. And the cool part about that is with modern medicine, people are living longer and living with things. They're not dying anymore. People aren't dying anymore just from, say, a heart attack, stroke, cancer, things like that. They're living beyond their illness or beyond their situation. And these policies will pay you a certain benefit if you get diagnosed with one of these things. Now, I don't wish this upon anybody, but it's good to know, hey, I've got this life insurance plan. It's not just from my life if I die, but it's also if, say, I have a chronic illness or a critical illness like a heart attack, stroke, or cancer, or a terminal illness, meaning a doctor says I've got 24 months or left to live. I can accelerate that benefit and use that money while I'm still alive. Awesome, right? So not only death benefit, but living benefits on top of it, usually automatically included in these new plans. Okay, so that's insurance. I said earlier that when the term runs out. I want to self-insure the rest of it. Well, how do I do that? Well, say today, I'm just going to round down. I'm 35. We'll say 30-year-old. And I get this big insurance plan. And then by the time it runs out 30 years from now, I get a 30-year term. I'm 60. Well, man, I don't have as much insurance. Well, over that time, I'm accumulating money in other ways, right? And you guys don't have a 401k with Beachbody. You don't have a pension plan. This is stuff that you need to do on yourself, for yourself on your own. One way you can do it is through safe money, and that's with annuities. Now, some people think annuity, and you listen to Dave Ramsey or Susie Orman or something like that, annuities in a traditional sense could be a 4-letter word to people like that. But if chosen correctly, and if we find the right plan, they can be a great thing. Why? Because you're not going to lose money. Now, I lost a ton of money in 2008 when the stock market crashed. That's one of my negative experiences with money. I enjoy safe money. I'm a risk-adverse type person. I'm more on the conservative side when it comes to risk versus conservative nature in investing. Annuities keep my money safe. Now, you can do this in two ways. You can take an old 401k or take an old lump sum of money you have and move it in there, or you can trickle money in there on a monthly, weekly, whatever kind of basis that you have, and accumulate funds that way in a safe account, safe money. Okay, that's one of the ways. Now, I say that just because I'm risk adverse doesn't mean I don't take any risk. I do. I just don't take as much as I used to, and that's where having a money manager or somebody certified financial planner, somebody who is going to invest your money directly in the stock market comes into play. Now, I have one of these, or we have one of these as well. It's actually a buddy that I play baseball with. Great, awesome guy. He manages our risky money. And that's where we've set up IRAs. Lauren had a Roth IRA until we met certain requirements and she no longer could have one. Now she has a SEP IRA, which is a simplified employee pension that you can have from your business. So as a business person, you can put up to 25% to a maximum of $53,000 a year into a SEP IRA and would count as a tax deduction for you. Now, again, you wouldn't be able to access that money until you're 59 and a half, but it's a way you can set up your own retirement account through your business. And an IRA can be labeled a number of different things. I already mentioned Roth. It can be a simple, it can be a SEP, but just making sure that look, you have two ways which you can accumulate money: safe money and taking some risk in the stock market with different forms of individual retirement accounts, which is what IRA stands for. And you can set up your own kind of pension since you don't have a 401k or you don't have a pension plan from Beachbody. Now, maybe down the road, they change their structure and they'll give you access to that. Great. But you still want to defer money and put it away for your future. So like I said, if I'm looking at this entire plan that I've got here, and I've got right now term insurance, permanent insurance set up for ourselves. And I've got my safe money. I've got some of my risky money. Okay. When my term insurance runs out, hopefully over time, I would have accumulated enough money and put enough money aside in both my safe money and risky money to now self-insure, right? Now I've got my retirement savings. And you see these commercials with guys carrying, a number on their side, or there's a number out there, and is it $1 million? Is it 800,000? Is it 1.5? How much money do you need? That depends on your lifestyle and what you plan on doing in the future. If you plan on working forever, well, great. Your kids will get it, grandkids will get it, what have you. But there comes a point where you're going to want to settle down. And if we're planning for that, we can do it through all of these things. And this is a plan. Again, everybody may not need the exact same that we have, but I'm sure you're going to need a little bit of all four of these boxes here, all four of these puzzle pieces to make a complete plan, a full plan, a self-completing plan, and one that you're going to be proud of, to know that if something happens, you're covered. And if it doesn't happen, you're covered. So again, this is part of the plan creation where we can get a little creative, and I can use my creativity. You can use your specific needs for yourself, your spouse, your kids, what have you. What I did not mention is child insurance. We have insurance policies, life insurance policies on our kids. Now, some people may look at that and think that's a little awkward, that, man, you don't plan on something happening. And that's absolutely correct. I don't plan on anything happening to my kids. But the type of plan that we set up also doubles as a future retirement plan for my kids. So it's a form of life insurance that if something did happen, God forbid, they're covered. But if nothing happens, and that's the plan, now this money that's set aside in this life insurance plan can also double as a tax-free type retirement strategy for my kids. So I'm going to share with them when they're older, hey, look, this is something mom and dad did for you. We started this when you were very young, and now you've got options. And if you complete the plan yourself, it's kind of like your parents passing over your car insurance to you or your cell phone bill when you got old enough. I want to pass this to them and have them continue to pay for it. And now they've got a head start. I've given them a head start because we started early. So that's just a strategy for kids. There's another plan out there that will get you, just very cheap term insurance on your kids. But whatever you want to do, whatever floats your boat, there are options out there. And I can't go into everything because for the sake of time, but I want to make sure that there are plenty of options out there, and we can put on our creative hat and look into what's best for you and your family. So all that being said, right, your financial future, how bright is it? After everything I've kind of gone over, and again, I went as quickly as I could for the sake of time, how does your financial future look? How bright is it? Are you doing the right things now? Do you have these things in place? Have you, made the right choices going forward for you and your family? Are you guys protected? Are you underinsured? In the rare case, are you overinsured? What is it looking like? Now, hopefully I brought light a lot of things that you may or may not have known about, but the only way that those things get changed is through action. It's the same thing in your businesses, right? If you want it, go get it. We had this thought in baseball when I was playing ball where guys would complain all the time, and bitterness, enjoys company, right? So one person says something to the next person, and then somebody would finally say, man, look, if you don't like the way it is, if you don't like where you're at, you don't like this city we're playing in, play better. Get out of here. Get advanced. Go up. Go somewhere else. If you don't like that you're sitting the bench, you don't play better. So if you don't like it, play better. Well, if you don't like what your situation is, only you can change it. If you want to plan properly for your future and you haven't started yet, only you can change that. And it takes action. It takes the first step. It takes moving and getting something going. You guys know that in your business. If you don't do anything, nothing's going to get done. If you don't contact people, if you don't approach them in the right way, if you don't ask them any questions, then chances are they're not going to know what you do, and they're not going to know that you can help. Same way here. So if you need help, if there's something in your situation that I can help with, that I can shed some light on, run you some numbers, and just kind of look at your situation and your family's deal, please contact me. Please let me know, how I can help. I'm not just Lauren's husband. This is what I do for a living, but my advice is 100% free, whether you need my help professionally or not. From an insurance perspective, just let me know. I'd be glad to answer any questions, point you in the right direction, share with you what I've learned just through my experience and also through my professional experience. But from a personal experience, I did a lot of the bad things, a lot of the things that were not part of this plan that I'm talking about today. So I've learned, and we've learned as a family, what to do and what not to do. And I'll just share with you that also, that when I left baseball, when I stopped playing, not that we had nothing, but I didn't have any of these things set up. Because while I was playing ball, I had health insurance. While I was playing ball, I had other coverages. While I was playing ball, I thought I was making a good enough money. And then when all that stopped, okay, we were just relying on what we had in savings. There weren't any other insurances in place. My health insurance was gone. Retirement plan, non-existent at that point. That stopped. So I needed to create all of these things from new, and I was already behind the 8 ball because I started late. So I wish somebody would told me this when I was younger, but I knew at that age when I stopped playing ball that I had to do something then. It was never too late. It's never too early, never too late to get started, but you got to start and do something. So again, my contact information here, my Facebook page is Val Majewski American Benefits Exchange. That's what ABX stands for. V Majewski at thinkabx.com, and then my cell phone number there if you ever need it. Recommend email and cell phone, easy. I'm not like you guys on Facebook. I probably need to take your guys' advice and get a little more presence on there, but email, cell phone, and I'd be able to help you out and point you in the right direction. With that, I appreciate you. for taking the time and coming out and listening to me. Thanks to my wife for allowing me to be on this call. And hopefully, again, you pick one thing out of here that makes sense and can definitely help you. So, Lauren, if you're there, I'll turn it back over to you, and you can close out your call.
Yeah. Stop your screen share, though, babe.
Oh, got it.
All right. There you go. Okay. So hopefully that helps you guys. And I know that we had a lot of questions that were popping up in the chat, hun, as you were going.
Yeah, I didn't have that up, so sorry.
Okay.
I'll go through it and
if you start back from I would start up at the top and go down. I know that.
I just saw that the word thrifty, so thanks for putting that on there.
Daddy.
Hi, Audrey. Okay. Where are we at here?
Oh, they were asking about our expense breakdown, or if you have any, we have the Excel spreadsheet that Val and I use in our Google Drive for Team Fit Force. If you just type in taxes, it will come up in the search bar. It's an Excel sheet. What I do is, and I'm actually behind on this, so sorry, Caitlin. What we do is I actually have everything in Excel sheets. I don't think I've done it for like the last 3 months, but what I usually do is I pull everything off of my PayPal and my credit card statement and out of my account, and we put everything into, hold on guys, go sit down. I put everything into the Evernote document that Caitlin has set up. And we just kind of have it all tracked out into expense categories. And then Caitlin takes it from there, and she puts everything into that Excel sheet that I have shared in the Google Drive. And we just total everything up so that it's done at the end of the year. And we just have to basically go back through and quick cross-reference and make sure that we didn't miss anything from PayPal or anything like that.
Okay. Well, Alyssa, I'll go, because right now for Alyssa says about mortgage insurance. So what was your question on mortgage insurance?
Like ever since we closed our house, we've been getting a lot of things. We went through Wells Fargo and they sent us all these things, get this insurance to cover in case of death, up to the amount your house is worth. But if you have like life insurance, enough.
That's what they're talking about. Exactly.
So you don't need that extra mortgage insurance, or you should have that on top of it?
It's still life insurance. They call it mortgage protection insurance. It's actually, we do that as well. That's just part of that dying principle, is the mortgage is just built in there. But some people, all they want to do is cover that mortgage, right? Just cover that portion of it, which is normally the biggest liability that you have. So when they say get mortgage insurance, and I think I might have told Brian that when you guys close, is you're going to get a ton of junk mail, a ton of things in there. Fill this little card out and we'll send you a quote, or guaranteed issue, or lowest price. It's essentially a life insurance policy, a term life insurance policy. You've got a 30-year mortgage. It'll cover you for 30 years. We have specific plans that are designed for mortgages where it'll decrease over time as your mortgage decreases. So it'll also help by the amount of life insurance decreasing. It'll also help decrease your cost. And it's a combination permanent insurance and term insurance. So it's a really cool type of plan. But that's all they're looking for. They're looking for to cover your mortgage liability with life insurance.
Okay, cool. Thanks.
No problem. I saw another question here about whole life insurance. That was Heather. Okay. Well, thoughts on whole life insurance? Traditional whole life insurance is kind of, I don't want to say going away, but there are variations of permanent insurance that are very advantageous for people. There are whole life insurance plans that are beneficial because they build cash value, and there are a lot of strategies out there. And I didn't have time to go over this, but one of the strategies that I've set up for myself and us is a tax-free retirement strategy. And what that is instead of putting money into an IRA or Roth IRA, because that's one of the only other ways you can do tax-free, is putting money into a cash value life insurance plan, basically overfunding a life insurance plan so that it helps generate and build faster cash value. The way the rules are stated is cash value from an active life insurance policy is not considered taxable income. So as long as I keep that a life insurance policy and maintain it as such, any of the loans or withdrawals that I take from it or income streams that I take from it will come off tax-free. So it's a strategy that a lot of people don't know about, that a lot of people haven't heard. It can be done with whole life, but it's more done with universal life and a plan called indexed universal life insurance. Very cool. And that's the type of plan I set up for us. So you fund it, and these things have to be funded. I mean, it's a life insurance plan. So if it lapses, it kind of defeats the purpose. So once you commit to it, it is a commitment. It's a long-term deal, just like setting up your IRA or your 401k. It's a long-term investment. But it is something that can pay off, huge dividends for you. And I don't mean actual dividends. I mean just the term dividends in as far as limiting your tax liability when you get older, and also impressively building cash value because of the way these things are structured. Now, that being said, they have to be structured properly, because I don't want these things to blow up on you, because it is life insurance. But if you've got disposable income and money you want to put somewhere that's safe and not necessarily in the stock market and can come out tax-free in the end, that is a great option. Not for everybody, but I said it was a good situation for us. Something I wanted to do for a long time, but just we weren't in the right spot, and now we are. So I've done that. That's a portion I've added more recently. I really like their strategies. Actually, I ran several illustrations for our agents today on those, and they were awesome. So hopefully that answers your question there. But I deal in all different types. So it is whole life, universal life, index universal life. The only thing I don't do is actual investment in the market. Again, I'm a risk adverse. Somewhere in there I read the word thrifty. I kind of breezed past that comment. But yes, I did get called thrifty at a carpet store one time. And I looked at the lady and she said, since you're such a thrifty shopper. And I said, you just called me cheap, didn't you? And she said, yeah. I said, well, I don't mind it, because that's a nice way to call me cheap. But I like protecting our money. I like making sure it's safe and sound. And by the different ways in which we've done it, we take some risk, but it's within our allowable risk, and protect the bulk of it. Other questions? Anybody? I'm trying to scroll down if anybody's got any other questions or things that make sense. Otherwise, if you contact me with your personal deals, we can take a look in more detail of where you're at. And even if you need things reviewed, because some people have looked at me and said, hey, I've had this life insurance policy for 10 years. I don't even know what it is. I don't know if it's term, if it's permanent. Some guy sold me something. Or if you have something that you thought was a good idea at the time and maybe your situation's different, just to get a peace of mind and get a review of what you have or things that you've been sold in the past. Lauren?
Sorry.
Oh, no problem.
Is there a minimum? Caitlin asked if there is a minimum amount a month you have to pay.
No, it depends on the plan. And obviously if it's life insurance, then, it'll be based on your rating and your age and things like that. There will be a minimum for that type of plan that I was talking about. But even if you're putting into like an IRA, if you're putting into a flexible premium annuity, these may be foreign terms to you guys, but a lot of times the minimum's like $100 a month, sometimes lower, sometimes higher. But just generally speaking, the only way that you're going to be able to fund your future or put money aside is if you do it. And the more you can, the better. And then if you do it sometimes in different, just depending on the classification, it can also be a tax deduction, which can help you come tax time. So to answer your question, Caitlin, there is, but it's going to be different for everybody. My financial advisor told me that huge price up since I didn't make all out this year, I'm actually able to write it all off. Yes, there is a chance that your expenses could equal your income. And you'd essentially pay zero taxes. Now the problem would be you would essentially net zero because you spent all the money. You can look at it either way. You don't owe any taxes, but you don't have anything. So it just depends. You don't have any money. You may have spent it on things or other stuff that's a write-off, like trips or travel or whatever, but you could net down to zero. Now there's there's ways that they talk about, taking losses in investments and things like that could help. But that means you took a loss or something. So essentially, that's, again, I said I lost a lot of money at one point. We did, and I'm still getting a tax deduction because of it. Not a significant one, but every year it reminds me of the money we lost. So you can look at it either way. So you're welcome. Anyone else? Okay. Ooh. Paying and saving. Okay. Depends on interest rates, right? So a lot of, from a traditional debt payment perspective, if you have a lot of debts, you have student loans, credit cards, mortgage, car loan. We'll just say you had those 4 things. Which one's going to have the highest interest rate, and which one can you pay off the fastest? That's the one I start with first. If it happens to be the same one, awesome. If the one that has the lowest interest rate is one you can pay off the fastest, then we have to juggle it. But a lot of times we're looking at, paying off debt is devoting all of our attention towards one at a time. Where people get sidetracked is when they say, well, I owe $50 on my minimum payment for my credit card. I'm going to double it. I'm going to do 100, but your balance is 10,000. That's really not putting a dent or doing anything for you. So put as much or devote as much money. And it is kind of a Dave Ramsey type principle. And there's other people that have said it or done the same thing, just say it in a different way. But you kind of got to map out what's your minimum payment, without going into crazy detail, usually it's which one you can pay off the fastest and which one has the highest interest rate. Let's get rid of those first, so that way you're not paying any unnecessary interest. And then you devote all your money, once one's paid off, towards the next one. And then it keeps snowballing, like you said, debt snowball effect. And eventually your debt is completely paid off. And now you take that money that you've been spending and you put it somewhere for your future, into a retirement account, into an investment account, whatever it is. So yeah, Financial Peace by Dave Ramsey. That's kind of a principle in there. But it sounds great in theory, but a lot of times it's very tough to do in practice. Susie Norman says, use your savings since your interest on savings is much lower. Yeah, it just depends, on the situation. Some people just have the different types of debt, different interest rates, different things that you've done in your past that could affect you now. Some debt is good. Not all debt is bad. But for the most part, things like student loans, credit card, high interest credit card debts, things that normally people are paying off the quickest. I actually had to talk about that on TV here one time, about paying off your credit card debt, which was kind of funny. The segment was called Curing Your Summer Spending Hangover. It's on our website. You can go check it out. Except they spelled spending wrong on the graphic on the TV, and it said Curing Your Summer Sending Hangover. It didn't make any sense. Brian is like, well, again, I'm not an expert in anything, one thing. I'm not going to claim to be the best person out there, but I'll give you honest advice, accurate advice. Obviously, I'm a business person just like you. I don't have to say that, but I'll be able to help you in the best way I can. If I can't, I just hopefully help you, point you in the right direction, and maybe get you to somebody who can. But I'd always recommend, look, if you want, use me as your first line of defense, and hopefully I can help. Okay, we are credit card debt free. Yes, we weren't always. Lauren. No, not just Lauren. I had credit card debt too. I'm going to pay for that.
All right, guys. Well, anybody else have any other questions for Val? If not, then we'll let you guys hop off. And if you guys think of anything otherwise, then you guys can feel free to, he's in our team page. So you guys can just
I don't go in
tag
there. I'm
him.
sorry, I'll be honest.
What?
You can see, message me through there because I've never been on the team page.
Oh, okay. Well, yeah, you can send him emails or you can call him, but you can tag him in our comment section of our, he'll see it if you tag his name. So let's put it that way. If you tag his name, he'll see it in his notifications, but tag his name. His name there is not Val, it's Walter Valerian. So I'll tag him on the actual picture. So he'll see things that are being commented, but you guys can leave feedback there, or are you guys doing?
Avoid Jeremy. Me
neither. But yeah, so if things come up, you can always ask there, or just reach out to him via that way. So there he is. Hey.
Where's the dude? Oh, he's sneaking. Why are you hiding? You have to hide that guy.
You can unmute yourself, Steph. Here, I'm going to stop.
It is hard to hide him, but he's too busy playing Bejeweled.